Let's go out there. It's August 23rd. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. Man, what a week. Just back from the Crypto Connect Expo in West Palm Beach. Met so many amazing people. It just blows me away how big their followings are in social media. Hundreds of thousands, millions. Just walk up to you, start talking to them, they're like, yeah, follow me, or you can see these follow. I'm like, holy cow. So many of them are all in the NFT space, the Metaverse, for its true ownership. Just a way to monetize themselves, which is their brand, their name. I'm going to get more on this later. Really digging the weeds. Great interviews. Awesome stuff. Also ideas. We were there for 4 days. Probably did 25 plus interviews. Hosted panels. Really cool stuff. A lot of tokenization, too. A lot of tokenization talk at this thing. I'm like, I think I'm the only person there that actually has a security token. They didn't put me on that panel. They was talking about how big it's going to be. I'm like, yeah, I think I know that. So it's pretty cool. But at first, I want to talk about the markets, right? Because you know what happens every single time I go away and I go to a conference or I'm working hard for you guys, the market comes down. It's never easy. Makes my job harder. Get tons of emails, which is cool. But we had a real crappy day yesterday. People get more and more worried that we're heading for a recession. The only person, or should I say the only organization that's not worried, is the Fed. They don't see it. At least that's what they're saying, right? Powell, Fed Chair, he's going to speak Jackson Hole Friday. And the tone from him and every other Fed president is that we're not seeing any signs at all and inflation is moderating. No signs at all. Which means pedal to the metal. That's in terms of rate hikes. Which is weird because we're really seeing clear signs that inflation is moderating. I mean, to be fair, there's also signs inflation is still being stubbornly high. We got food, we got rents, natural gas, hotels, airlines. Yes, we see it. But clearly, lots of signs. It's not just moderating, but crashing certain industries. Like the most important driver of the economy, which is housing. So new home sales came out today. They fell 12.6%. They were supposed to only fall 2.7%. Guys, when it comes to economics and this data, you never, ever see something like that. Like these wide swings, like the expectations are this far off, are massive. Massive. Because these are when they say they beat estimates, that's the economists, right? That's all the economists. That's their estimates. Package them all in and say this is the average. And these are the guys that believe the Fed's going to continue to raise rates like crazy. These are the guys that are saying we're not really seeing those signs. Inflation's moderating. That's a 2.7% estimate. So at 12.6%, it's like slapping you in the fucking face and saying, there it is. There's the sign. If you can't see it now, fine. Well, it's the worst since 2016, this number. I'm going to put that in perspective because it doesn't seem like a long time. But the housing market eased up incredibly in 2016. Why? Because that's the first time the Fed started raising rates. First time since the credit crisis. 0, they said we're going to do it many years before they didn't. It's at 11, 12, 13, 14. They talked about finally, right? Raised by just 25 basis points. And yes, we had some fears that China was rolling over a little bit. But just from the Fed raising rates that much, and it's not the 25 basis point, right? That filters through the system. Yes, 25 basis point hike. It's the fact that we were going to see interest rates go high for the first time in a very long time, and it spooked the markets, especially housing. And housing slowed considerably in 2016. Because when I saw this number, 2016, I'm like, 2016? I don't remember the housing market slowing that much, but apparently it did. New home sales. Scared to build. Rates are going high. The Fed's talking about it. We're at 0.5% right now. It could go to 1%. It could put mortgage rates up to 4%. Holy cow. We're at 5.8% in the 30-year right now. We're at 2.5% immediately within 6 months. 0 to, not 100, 250 miles an hour. That's how fast we did this. And you have to realize how a 75 basis point hike compared to 2016 and how it resulted in a slowdown because of the fears that rates were going to go higher. We're higher. And now we're fearing that it's going to go to 4%. Are you crazy? 4%. Just crashed the entire housing market in 6 months. And there's still pockets that are doing okay. I'm doing okay in Florida. Other people doing okay in Texas and some of these areas. Paying cash for your home, you're still getting good deals. But man, if you're borrowing money between that, whatever, I don't know if you get a house at $250 these days, but between that and $500,000-$600,000, the real estate agents I talked to said it's drying up. It's horrible. And you're looking at the supply. Over 10 months of supply. What does that mean? On average, it should be 4 to 6 months. I think it was below 2 months or 1 month at one point. It's like everything was coming on the market was just gone. It's 10 months. Now, these home builders are sitting on tons of inventory. What does that mean? It's not inflationary, it's deflationary. How are they going to sell this? You have cancellation rates surged in May, through it up to May, right? In a couple of months when we started raising rates in March and February too. And in January, when the Fed just started talking and going crazy, raising rates significantly, we were so wrong. It's not going to be transitory inflation. It's here. Holy cow. But since May to now, they doubled again the cancellation rates. That tells you how bad it's going to be. And remember, when I said about 2016, we're looking at rate hike of 25 basis point hike, and then expectations that it's going to go higher, maybe to 1%, 1.2%, whatever. We just did 2 75 basis point hikes back to back. Pretty sure, what was that, June, July, or a month before that, whatever, back to back. And before that, it was 0.5 hikes. I mean, it's insane of how fast. Last time we did this, 1994. A 75 basis point hike. This is the fastest rate rates in close to 3 decades. But you look at the home builders right now, and I think Toll Brothers reports this week, not too sure what day, maybe it's tomorrow, but take a look at what they have to say. It's going to be a lot different than what they were saying in the past. But if you look and say why they have tons of inventory, builders were balls to the wall post-COVID. $11 trillion injected into the system, handed directly to people. People buying houses like crazy. Then we had supply chain concerns. They were saying demand has never been this strong in the history of our industry. And they were right, because you injected $11 trillion in less than 18 months into the system and kept going and going and going, even though asset prices, including housing, surged to all-time highs. Earnings surged to all-time highs. Car prices surged to all-time highs. This was in early 2021, and you still injected another $4 trillion into the system over the next 6 months. Are you crazy? Trillions. So for 2 straight years, these guys are like, we've never seen anything like this. And even as little as 2 months ago, home builders said, we're not seeing the consumers slow down. I mean, home builder prices went sharply higher off their lows. But this is 2 months ago. And I'm going to tell you, because the home builders, at least from the perspective of their conference calls now and where they're positioned, they're going to experience the same fate as the retail industry. The Walmarts, the Targets, the Kohl's. What happened? Seeing massive demand, ordered tons of inventory. Need those products. We're seeing massive demand, right? It was given to supply chain concerns as well. We have to get this through the system. Just whatever we need to do. And Walmart and Target are great companies and figured it out and got a whole bunch of shit through the system, which a lot of companies weren't able to do, right? They still have supply chain concerns. Got all of this product. Now, here's the demand. What happens? Demand falls off a cliff. It falls off a cliff. Force them to what? Lower prices to sell the excess inventory. Deflationary. Remember how fast these large retailers saw the dramatic shift in sentiment. It was like 30 days. The first 2 months of the quarter were fine. The last day, as you see, both Target and Walmart, companies, when it's that bad, they'll come out, the big companies, and warn and say, look, we're lowering our estimates into the quarter. Here's why, blah, blah, blah. I don't know. It's kind of like a tip to the hat to Wall Street and say, hey, we know we talked to you guys and we were wrong and we don't want you to look like idiots when we come out with these numbers. They didn't even have time to update those numbers or to report that guidance before they reported. And what happened? They got wrecked. Both names saw the sharpest decline, 1 day decline since 1987, since the market crash in 87. Holy cow. That's how fast it happens. There's a bigger point here. Yes, you have the home builders sitting on massive inventory. Supply numbers is surging, right? Over 10 months supply down in the market. So definitely going to need to get the inventory off their books so they have much lower prices. But think beyond the home builders. They have thousands of companies that supply them. I just went through this. building my new home. Hopefully it'll be done in November. But the whole supply chain concern and everything, I mean, there was one area where I got wrecked on, which is the pool, which is a joke. Everything else, this is a large home builder that does custom homes. So they had a lot of supply, which a lot of people didn't. But you saw lumber prices come down, a lot of stuff come down. Plus, I was able to lock in lower interest rates. It was still very high, and I can almost guarantee a lot of stuff I paid for is going to be a lot lower 3-6 months from now if it's not already. But I went through this. Oh, we have to tell the suppliers. Oh, we have to switch this. Oh, you like this brand? Sorry, we can't use it. We can't have this. They're not getting it to us. It's a 9-month wait. So we switched to plus. So you got to pick from this group instead. Think about every single thing you have. There's thousands of suppliers, right? Thousands. What are they going to do? Who's the number one customer? Home builders. They're all cutting orders. They're in scrambling mode to reduce the massive amount of inventory they have because that's 2 months ago. Again, 2 months ago. Consumers fine. We're seeing everything great. That's how quick it can change when you're looking at interest rates. It's what higher rates can do to the economy. The Fed was able to crash the housing market in 6 months by raising rates at the fastest place in close to 3 decades, right? Like I said, last time we saw a 75 basis point increase was 1994, and we just had 2 back-to-back months. And before that, 50 basis point. And then next month, what are we going to see? Another 50 point rate hike. But the hikes that have already taken place, have already happened, they're not filtered through the economy yet, guys. They're not. On a scale of 1 to 10, you ask me how much is filtered through the economy? We're at a 4. Right now, we're at a 4. This still hasn't filtered. It's not like, wow, we're seeing it. Okay, keep going. No, we haven't seen it yet. We're just starting to see. Usually it takes a little bit longer, but we raised by so fast, by so much so fast. I mean, look at the housing market. It was booming 6 months ago. It's crashing. It's important for every investor. You need to realize that it's going to get a lot worse just with rates at 2.5%. Because the Fed plans to raise by another 50 basis points next month. And many economists, granted, who have been so wrong on inflation over the past 2 years and are still wrong now, that's why you're seeing the numbers come out with a 12-point whatever decline for housing when they're expecting 2.7%. Look at the manufacturing index. What is it? Minus 30 compared to minus, 7 or 8 there, whatever it was. Why is that huge discrepancy? It's because the economists are so wrong right now and they have no idea, and they're all programmed the same way, wired the same way. Let's just have good contacts with the Fed. Revolve all models around there. Don't go against the Fed. This way we always have access and all this shit. But for them to say we're not seeing any signs and be this far off on these numbers, guys, economic data is something I follow for over 20 years. I love this stuff. I don't blame everyone for hating this stuff. It's my job to explain it to you. You don't see these numbers that far off ever, unless there's something boiling below whatever, because the economy, you don't see that during regular economic times. Even in, you see a slowdown here, not that much of a discrepancy in what the economists are projecting and what the numbers are coming in at. And we keep seeing it and seeing it and seeing it. And that number's coming in now a lot worse than expected. And it's going to. At first, it was coming in a lot higher than expected, especially with inflation. Now you're going to see it come in a lot lower than expected. And you have to be careful. It's a big deal. It's not citing why the Fed is wrong or why the economist is wrong. What I'm saying that if Powell pushes the Fed funds rate to 4%, or continues on this where we're at 2.5%, here comes another 50 basis point increase, we go to 3%, and he's still going to say, I'm seeing no signs. Again, he's talking to the markets. That's perception. That changes sentiment. The Fed could change sentiment just by talking. That's what you saw in 2016, and why the housing market so considerably when they just raised rates by 25 basis points, because it was the expectations of them saying, we're going to start to raise a lot more now. So right now they're raising a lot more and saying we are not stopping. We don't see it. I'm hoping they do see it, and I understand why you're saying it, because you don't want to come out dovish because you made that mistake already and the market surged like 1,000 points in a day. Remember that? After the first 25 basis point hike? Oh, we're okay. We might do more. Might do more. 3 weeks later, they came out with, 1 week later, they came out with a press release saying, no, we're going to get more aggressive. Then what happened? After the 25 basis point hike, 50 basis point hike, 75 basis point hike. This is when Powell said after the first hike at 25 basis points that, we're going to get a little dovish. He's not going to make that mistake again. He's not going to go on and say, no, I'm seeing signs in it because you're going to see the market, money start pouring in. Again, it might take a little bit longer for inflation to cut. You need inflation to come down. He's trying to do it without crashing the economy. If he goes to 4%, we're not just going to go in a recession. We're going to go in a very deep, deep recession. I'm talking about we're not just going to retest the lows. We're going to go down probably another 15% from those lows. That's how bad it is out there right now. People are getting stretched. They're changing their habits. They're going to buy less food because these prices are so high. They're going to find ways to save on gasoline, which they did when gasoline prices were $5, and that's why you saw demand come down. That's what lower prices, that's normal. That's why the Fed always believed inflation was transitory. It usually takes care of itself. You raise prices high enough to the point where you can't raise them anymore. No one's going to pay for that, and then they come down, right? You see transitory. Because outside of the 80s, that's what usually happens. But this time, it's different. Because the Fed was caught completely off guard. We injected $11 trillion in 12 months into this economy. It gave us money directly to business and consumers. So it takes time to shrink this money supply, this $11 trillion, but it's working. It's working. You could see it. Look at the leverage in the stock market. Technology, biotech, cryptos. You see the money come out of there? Look at housing. Probably the quickest I've seen this market crash since I've been alive. You say, Frank, what about 2008? 2008 was different. It took a while. Stuff was, you can look at the history timelines, and you just like look at 2006, how many firms blew up. Then 2007, where housing prices finally topped out and the market started to collapse. And it took 2008, 2008, it didn't take 6 months. Of course, this is different than that market. Housing's on a much better footing. You need more than a library card and no money in the bank to buy a house these days. You didn't need more than that back in 2004, 5, and 6. And selling all those loans to whoever, Fannie and Freddie, whatever you did. But this is different. Banks' balance sheets are stronger than they've ever been. They're raising their dividends and buying back stock because they're being forced to keep all this capital on their books, at least a lot more of it. People are paying their mortgages, right? There's no credit crisis here, but in 6 months, we took a booming industry, one of the most important drivers of the economy, housing, which based on Zillow, total value of this market, as of February, before it started to crash, is $40 trillion. And in 6 months, the Fed, boom, was able to crash it. That's how powerful the Fed is. That's how raising rates this quickly, that's what it can do to markets. It can impact the biggest industries in the world in months. Now imagine if Fed decides to go to 4%. What's going to happen? Because we talk about housing. We saw the same thing in retail a few months ago. With rising rates so fast. We saw it in crypto, causing massive deleveraging, also in biotech. Just mentioned that, right? What's the next sectors to watch for? That saw huge demand to the point that they couldn't get enough product to market. And now going to, holy shit, demand's falling off a cliff and we're going to be sitting on too much inventory. The next is going to be cars. There's a massive amount of cars being built and shipped right now to meet that huge demand. Where did demand come from? It came from pre-orders. From people like me, seeing how the system works, putting down, I think it was a couple of $100 on a Rivian truck about, 18 months ago. Still have, they update me and they tell me how much prices are being raised and stuff like that all the time, probably every 3 months. I'm not getting that car probably for another 6 months, at least a year, if I decide to get it. But look at the environment now where people had all this money, wanted to buy cars and EVs, and holy cow, this is great. And now look at today with the economy slowing. Consumers are getting pinched while what? EVs are up 20% year over year. Well, the average price is $66,000. Average for an EV. That's going to be $80,000 in a few months. Did you see the recent price increases from Ford and GM they just put through? As soon as we pass the bill for the, whatever, I can't even say it. The Inflation Reduction Act. I can't even say it. The inflation, we're gonna spend all this money. It's an Inflation Reduction Act. I know we're going into midterm elections and a couple months away, and you want to try to appear that you're lowering inflation in this current administration. I just love it. That's like slapping people in the face. It's like when you check out of a grocery store. We have Publix here. And Publix is very, very expensive compared to everybody else, but they have like more fresher food and stuff and whatever, right? And you go in there and they're like, oh, and they hand you a receipt. You just saved $6. And if you put that same thing in like a Walmart or whatever, or another grocery store, it would be like, you would have saved $20, but they actually slap you in the face and give you you just saved $6 by shopping here. Yeah, that's like the EV industry, right? It's like, and they raised prices. So Ford and GM raised prices between $6,000 and $7,500. They just announced these price hikes. And how much you're going to save based on the Inflation Reduction Act is probably less than that. So you're like, hey, here's tax credits and you're going to get this money so you could, and then what do? Ford and GM so basically it's a wash. You're spending taxpayers' money, but yet these companies are raising their prices by that amount, which is great. It's fantastic. Can't make this shit up. Anyway, won't get too political, but industry by industry, they're going to get hit by lower demand, especially those who had the worst supply chain concerns 6 months ago and a year ago, since they over-ordered. We're seeing it in the semiconductor industry, right? We're seeing it. We're seeing a lot of warnings. Some of them are doing okay, depending on what industries that you're in. But we're seeing that in semiconductors, where almost all of them, right? We're to the point where now that's why we're going to Taiwan so much, and with our politicians and who goes there and puts a little cap on the feather in that cap. Look, I went to Taiwan. I'm okay. Anyway, but we need to work with Taiwan Semi, where they have all the secrets, they have everyone, if we're going to build our own fab plants in the U.S. or whatever. But you're seeing it. We're not going to have to build a lot of these plants because demand's falling. It's falling. So to combat the supply chain concerns, a lot of these industries did well. Like I said, they raised prices considerably. But now you have a market where demand is slowing, you have rising inventory, and you can't raise prices anymore, which is deflationary, what we need. So if you're looking at inflation, it has nowhere else to go but down. The Fed, all they need to do, it's simple. Go on vacation for 6 months, come back February, March, and the markets will be fine. But if you're looking to go out there, raise rates, the bullshit talk, you're scaring the crap out of everybody. That's why you're seeing the markets sell off, because we see the signs of inflation coming down. Yes, again, I cited places where it's not, but we're seeing those signs, and they need to come down further. They're going to come down a lot further and faster than anyone imagines. For the housing industry to come down this much in 6 months, and how much is going to be filtered, how many things are sold through housing, the thousands of products, look through your house, all the things, right? All that. Demand coming down. Those prices at everything you see in your house. Next time you're at your house, you listen to this in your house right now, whatever you're doing, look around your house. Everything in there is going to be at a lower price. It has to be, because demand's falling off a cliff and nobody's buying houses. Very few people are. It's down tremendously. And you could say, well, it's temporary. It's not. When you see the supply of homes that high, that quickly, holy shit. So the Fed is in the driver's seat. If they really want to continue to raise, I get the 50 basis point cut to say, listen, let's just make sure after that, you need to stop. You may go up to 3.25%. These numbers are going to constantly get worse and worse, especially in housing. You'll see it across the board. Rents will be the last to come down, and food prices will be the last to come down, but you'll see it. You'll see it. But if you're just going to go out there and say, well, we don't see it. We don't see inflation coming down. We have no idea. And you're going to continue to raise rates and you're going to 4%, be careful. Because overshooting, extremely dangerous, by far the biggest risk to the market. If we don't overshoot, we'll be fine. We'll be fine. I like the equity markets. Still lots of bargains, especially in tech, biotech, small caps. These things fell 80% from their highs. Able to nail a few of them. Some are up over 20% from their lows, but still down tremendously from their highs. Good names that aren't really impacted too much about the economy, within biotech especially. A lot of these companies are going to get funded if they have the research and the technology, and a lot of them do. I mean, not a lot of them, but a lot of the ones that are down do. But that's my focus, and even small caps. I like small caps here. Small caps have got annihilated. They're more cheaper compared to large caps than decades and decades and decades. And they don't have to worry too much about the international demand, which is falling off a cliff, where inflation is through the roof, especially in Europe. And a lot of our companies have exposure to those markets, not to mention China. The information I'm getting from China, from subscribers, people that live there, holy shit, is it a disaster under the hood. It's not being reported here as much as it should be. They're doing a good job, China, of hiding all the shit with their property market, the things that are going on with their banking system right now. They're hiding it. A lot of our larger companies have exposure to these markets. Small caps don't. Mostly to the U.S., where we should remain pretty good as long as the Fed doesn't go absolutely crazy. With that said, if the Fed decides to push rates, and I would give it to 3.25% of what they say. Okay, I don't know what they're going to say in Jackson Hole. Looks like they're going to probably reiterate what they said in the past couple months. We're still not seeing signs of inflation, right? That's why you're going to see the market volatile, which is fine. But in September, when you raise rates by 50 basis points, that's going to be a big meeting. That's going to determine whether I'm going to push the issue on stocks or reverse course on a dime. Because if they're serious about going to 4%, you got to take money off the table. Equities are going to get annihilated. They're not going to come down a little bit. They're going to come down a lot. Right now, we're scheduled for a mild recession, and then March, April, May, start lowering rates, feed the market, get going again, more money into the system, which creates a nice market. If you have 12, 24-month time horizon, as of right now, be very, very, very careful. Very careful. And that's making people nervous. That's why people go on the sidelines. That's why you see consumer staples do good. That's why you've seen a dollar index at 19-year high or 14-year high, I think it is. Man, I lose track with all these 19, 14, 30-year high things and shit. It's crazy. So I've seen commodities go a little bit higher now. People get nervous. Let's see what happens with the markets. Let's see what the Fed says, Jackson Hole. But September is going to be the key reading because over the next 3 to 4 weeks into that meeting, we're going to see terrible, terrible data. Data that's clearly showing that demand is falling, prices are going to get lowered, and they're going lower. And I'm just hoping the Fed's not going to continue to raise rates into that type of market. They got to be smart on that. We'll see. Outside of those numbers, I wanted to cover the Palm Beach conference. This was great. Just amazing to see the younger crowd and amazing ideas. More importantly, how they trust us. Now we go into these conferences, we're building our brand, right? And it's not easy. It's not easy in any industry. Even when I went to mining, I have, Marin to thank for that and Rick Rule, and you have to be there and go participate in deals. It takes a while, especially in that industry, which, 90% of it is garbage and shit and scammy in mining, where to really get up the ranks to focus and have the inside on the good deals, the real people in that industry and not the scam artists. And I've done that industry by industry my whole entire life. And you have to build that trust. You have to be in the room. You have to go to these conferences. That's why I've been away 3 straight weeks. Holy shit, I'm tired. But you have to do that. It shows credibility. And not only that, the amount of money that we spent in commercial real estate, on the virtual side, the fact that we're putting our money where our mouth is. We're not just talking and saying, wow, this is a great industry. No, it's the biggest purchase we've ever made in the history of our company. It's virtual real estate. And then the security token and seeing how we're in that world. How many people and these big investors and real estate investors who have, billions of dollars and they talk about tokenization. I'm like, man, I guess we're early to that trend. And not that I'm saying rush into that trend, but it provided a great vehicle for us to go public, to have a better valuation on our company, and use our stock as currency to really spend money in high growth markets, which we're doing right now. The conference was pretty cool, a little unorganized because it's one of the first times they held this type of conference there, but it was expected. You have, again, the contacts with the Wall Street Bets crowd and the people that we got in there, just great people. By the way, didn't have anything to do with Bed Bath & Beyond. Like I told you, it's so funny. They're like, it was mentioned 5x more on their website. It was mentioned 5x more on every freaking platform because it was up 300% in a week. They were like, no, they weren't. I mean, they were buying that thing a long time ago and some of them sold out of it. But no, that's not what pushed that up 300%. They don't have the power to do that. I'm not saying that as a bad way, but they were laughing when, the person who runs one of the biggest parts of that blog on the Facebook side, great guy, really cool guy. I was like, did you guys have a lot of influence? He's like, no. I was like, nope. Weren't really posting it too much. Yeah, you had some guys like, trying to post it and whatever, but no, it didn't come from like, hey guys, let's all get together and, have millions of people all pump the shit out of this and buy it. No, that's Wall Street. That's algorithm. Sorry, guys. It's just funny. But getting in big with that and how big their crowds are, the huge influencers. And they don't let many people in their inner circles. They're asking us to help monetize their names, their followings, seeing them evolve into NFTs around their brand. Just providing special services for their best and most loyal followers. That's what NFTs are about. It's not digital art in a JPEG. Yes, there's room for that. A couple of them, cool, whatever. But that's not what NFTs are about. It's just creating ownership, non-fungible tokens. It's like tokenizing that asset. And now you're seeing fractional NFTs, which is basically what we did. It's not an NFT. It's a security token. We fractionized ownership. You sell off a small piece of your business to investors, just like you would do in the stock market, but it's a lot easier. But it's just how many of them are pushing the metaverse is incredible. They don't want to be in a movie that we're doing, and I'm excited to launch this thing. I'm going to get it out by next month, which is like right around the corner. But really excited because we have so much awesome footage, and I want to show the world what I'm seeing. And it's not video games, guys. The metaverse isn't video games. It's not all about kids just playing and hanging out. You're going to see why every major retailer is going into this industry. You're going to see why the walled gardens, which are who? The owners of the internet, the Facebooks, the Googles, the Amazons, the Microsofts, the NVIDIAs, are the biggest investors in the metaverse right now. Why is that? Because they know the days of them owning the internet are numbered. That's the biggest driver of NFTs. It's the biggest driver of cryptos. It's the biggest driver of the metaverse. The chance for everyone to own their own content, their identity, without having to share it, and not getting all your data stolen and sold to somebody without even knowing. Now we all know. That's where all the money's going in a market that is pretty terrible right now. Where IPOs have shrunk up. Worst IPO market I think I've seen since credit crisis, probably even longer. SPACs are done. Try raising money for projects, nothing. Try raising money for good metaverse projects. You're seeing billions flow into that, and NFTs right now continue from the biggest investors in the world. There's a reason why. There's a reason why. And meeting those people influence is just one small part. I mean, the amount of developers, holy cow, what these guys are capable of doing. I mean, showing us our technology and just for us learning about the technology, it's going to power the metaverse, like Unreal and Unity and what they're doing with these engines. How they had us build a $5 million commercial real estate property that we bought. And by the way, the recent sale in TCG, which is a couple of weeks ago, like 2 weeks ago, this was a new sale. A plot was sold for $7.5 million. $7.5 million. To put them in perspective, we own 12 of those plots that we purchased for $5 million. You could do the math. If you want to listen to Mark Cuban, where sales of commercial real estate or real estate, he didn't say commercial real estate, virtual real estate is the worst investment. It will be the worst investment 7-8 years from now when the day happens where we could transport all of our material from one place to another within metaverses, when there's kind of like one metaverse or two. But right now, there's a fight. With TCG, it's one of the first open metaverses. Will they get it right? I hope they do. I don't know. I'm betting on it. Everything else is a closed metaverse. You need permission to enter. All the money flows to those companies. This is an open. It's going to be one of the first truly open metaverses. That's why land's going like crazy, even though land on other sites is starting to fall a little bit. You need permission to access it, build on it, own your own content. That brings the best developers right to your door. So for us, owning real estate, commercial real estate in those areas, right? The stuff they're building where we could lease our real estate to them. Let them build out our headquarters or anything we're going to do. When it comes to the real estate, give them a small equity stake. I could do that. Just have them unleash their talent and imagination. Here, you build it. We're going to take a big portion of those revenues until you get started. We can rework that deal or whatever, but that's the access that we have. Unleashing innovation. But these developers go nuts. See what they could do with this site. But we have the real estate, and I can't tell you, at least 3 people came to me looking to purchase that real estate right now. Not the whole thing, but pieces of it. And we're deciding how to structure those deals and work with those companies, and that's what it gets pretty cool. It's part of our company. Still stocks. We started the whole presentation, the monologue on stocks and what's going on, but a lot of these people had those questions on stocks and whatever. What I do know is we're starting to really build our list of the millions and millions and millions of followers that these people have and trusting us and sending our information to their lists, wanting to get to be a part of the movie and also be a part of investing. And that's the name of the game when we're a business. We have to add more names at the lowest cost, and we're doing that from people that we trust, people we want to work with and deal with. And it's a lot of fun right now, and it's pretty crazy and very busy. But I'm always going to be there for you guys, even on days when I come back in the middle of the week, basically, and tired. So I can have these podcasts, but really looking forward to expanding our position in this industry, and it was a lot of fun. Because building that trust between these organizations, you'll be in a good position, right? 30 years of Wall Street. So we have a lot of people with money trying to push into this industry that talk to me and say, Frank, we need someone we could trust. We know there's a lot of shit in NFTs. We know there's a lot of shit in the metaverse. You know, we'll follow you. And now for me going out there and find the right deals, right? Especially in crypto, it's hard to get people to trust you in crypto. And we have that, which is awesome. So I'm going to bring the right ideas to everyone listening to this, Wall Street, everyone, being the middleman on this. Everyone's getting to Web3, the metaverse, NFTs. And a lot of these guys have great project ideas that are looking for funding and help structuring their companies. Again, put us in a good position. So I'll get more into the details of that, like the people we met, the cool projects we like most, our best interviews. I did like more than 25, I think, in 2 days. Get more into tomorrow's podcast with Daniel, which will be a small part of that. And we'll talk about the markets and stocks and ideas like we always do. Also, if you're a Crypto Intelligence subscriber, which means you're a paid subscriber of one of our premier products, you can see a lot of new ideas, original ideas being recommended in the months ahead. Including having access, and this is going to be really cool for you guys, to fund some of these projects that I'm personally putting money into. I'm not getting paid by these guys at all. We can get an equity stake. I'm not talking about just buying a token early and getting it. No. Those are utility tokens. Getting actual stake, equity stake in their companies. I'm going to be open to a lot of those ideas going forward, which should be a lot of fun. And I'm only going to, you guys can participate if you want. If not, no worries. But these are going to be deals that I'm putting my own personal money into. I don't get paid by the companies. And a lot of these could be Reg A's. We'll see. If not, it might be open to credit investors, but at least we're going to be able to offer some of those from what I'm seeing right now, which is very, very exciting. So, guys, that's it for me. Questions or comments? I'm sure I'll have a lot after this podcast, but the markets end the crypto conference we just went to. Feel free to email me, frank@curzioresearch.com. That's frank@curzioresearch.com. Really appreciate all the support, and I want to give a shout out to my subscribers that showed up at the Palm Beach conference, got the VIP tickets for free, met in person. Really, really appreciate it, Javier. I'm going to give you a shout out, who's someone who sold his production company, and he actually did the introductions of me when I was on stage, because he showed me a video he did for ESPN with 1,000 people there, and he's fantastic. So it was amazing. It was really, really amazing. I love meeting my subscribers, people in person. It's just really cool, and I enjoyed that. So that's my favorite part of the job, is meeting you guys in person. So traveling a lot, getting those conferences going, even get our own conference going pretty soon, a Curzio Research Conference, and getting that, I know a lot of people have been asking that. Curzio One member is going to start doing that, getting that off the ground. I know it was COVID and stuff, but traveling a lot, getting a chance to meet a lot of you in person, and for me, that's a job. It's awesome. I really, really love it. So thanks, guys. Showed up, meet me, supported me. I love it. I'll see you guys tomorrow. Take care.